because gold and silver physical in your possession is a savings-based currency. That's why gold is the primary currency metal, silver is the secondary currency metal, and cannot be inflated away because it has the broadest base of use, and therefore the broadest base of demand. And that's what takes it away from being an asset that can be manipulated. Well, so we've got to talk about debt, because can you really fix a too much debt problem with even more debt? No, you cannot. But you can take advantage of the circumstances if you're up at the top. Us little people down at the bottom, maybe not so much. But we have to talk about what's happening with debt, because we are at the absolute end of this currency's life cycle. There just isn't a whole lot more purchasing power to be inflated away, and yet that's where we're evolving to. So here we go. U.S. companies to boost their borrowing in 2026. Shocker! And who's telling us this? Wells Fargo. But JP Morgan also sees an AI boom driving record bond sales. Make no mistake, a bond is a debt instrument. It's just a longer one. Whoa. So, this is happening all over the world. In Japan, 132 billion borrowing binge reshapes global credit. Do you see what's happening here? These companies all know that we're declaring bankruptcy, that the government, the central banks, because there's only one way to fight deflation, which a debt bomb exploding, quite honestly, what does that do? It's very deflationary because everything implodes. Markets implode, real estate implodes, everything implodes, and we're already on the downside of this. So why not? If you know you're going to declare bankruptcy, why not take on any more credit? But I hope you can see the gold coins all around this desk, because if you're holding gold when this happens, and if you're holding silver when this becomes apparent to everybody, you will be in the best position possible to take advantage of what happens, right? Never let a good crisis go to waste. Why does it always have to be those at the top that get to take advantage of it? Because when we're looking at all of this level of debt, it's just higher and higher and higher, because the more debt they grow, the less impact that debt has. And the Federal Reserve has certainly learned that from coming in since 2008, right? The more they do this, the less impact all of it has on pushing up the prices. Not that those prices don't go to nosebleed levels, but let me tell you, there's only so much debt that you can take on.
Despite the risks, corporations and governments are preparing to borrow more than ever. Major financial institutions project record bond issuance driven by technological investment, slowing growth, and rising fiscal stress. A bond, after all, is simply delayed repayment. Japan offers a clear example, with massive borrowing reshaping global credit flows. These actions suggest quiet acknowledgement that deflationary pressure is unavoidable. When collapse becomes inevitable, the incentive shifts. Borrow while you still can. This is not confidence, it is strategic positioning ahead of systemic restructuring.
Look at this, annual overseas note issuance. So a note is also debt, it's just a little shorter term, is on course to exceed debt sales in yen for the first time ever. The first time, because there really is no choice. Japan especially, they've been the poster child for how to fight deflation. And really, it hasn't worked. But again, insanity is doing the same thing and expecting different results. But honestly, that's our assumption, that we are really expecting different results, isn't it? Because the reality is the level of debt that's been created as we've gone through these different cycles from 2008 to the next big debt explosion that happened in 2020. So what's next? Well, a lot of crisis is next and a lot more debt. And I cannot stress this enough. You cannot fix a too much debt problem with even more debt. But truthfully, how do you deal with all of this layers of debts? Because it just keeps going up and up and up. Does a tree grow to the sky? No. You have to have a correction along the way. And that's where what the banks do is leverage that debt. This is a graph on the derivatives held inside of the FDIC insured bank. So why do you care about this? Because it's taking that mountain of debt and putting even more leverage and debt on top of it. So these banks, JP Morgan, Wells Fargo, a Bank of America, Citibank, these large banks have taken all the debt that they've issued and then conducted God knows how many leverage bets against them. But it's higher than it was in 2008, that level of leverage, which means that this next big debt explosion is going to be a whole lot worse than it was in 2008.
Debt alone is only part of the story. The real danger lies in how that debt is leveraged. Major banks have layered derivatives and complex financial bets on top of already historic obligations. Today, derivative exposure inside insured banking institutions exceeds levels seen before the 2008 crisis. Leverage magnifies outcomes in both directions, and when conditions turn, losses cascade rapidly. In 2008, the system failed and was stabilized through extraordinary intervention. This time, the scale is larger, the tools are weaker, and the margin for error is far smaller.
In 2008, the system died, and it was just put on this money printing life support to hide what was really happening until they could get the next iteration of a financial system in place. And what I'm holding in my hands are the representations of digital currencies that are quite designed to look like gold. Because even though they poo-poo gold, and of course now they're starting to see the value in it, Wall Street is, but they have poo-pooed it because they don't want you to hold it, because it is the only financial instrument that runs zero counterparty risk. A contract is all counterparty risk, and we are very much at risk. But what I think is extraordinarily important is what I'm showing you here on this graph, is that net demand here in 2025 is outpacing the demand that was set during the last financial crisis in 2009. That's extreme. That matters so much. In tonnage terms, demand has also been robust, with North American funds on track for their third strongest year on record. Yep. Why? Because gold and silver, physical, in your possession, is a savings-based currency. That's why gold is the primary currency metal, silver is the secondary currency metal, and cannot be inflated away because it has the broadest base of use, and therefore the broadest base of demand. And that's what takes it away from being an asset that can be manipulated and controlled and devalued. They can create as much of this as they want. And what does that do? Well, that suppresses the price that you see, those spot contracts. But they don't refer to those spot gold and spot silver contracts as spot contracts. They refer to them as gold and silver, just like they're doing with these cryptocurrencies, Bitcoin, making it look like it's gold. Do not be fooled. Education is key because after all, how many times can you be lied to when you do not know the truth? You want honest money? That's the problem, is that it's debt money.
While paper markets expand, physical gold demand is sending a different message. Net global demand in 2025 is tracking above levels reached during the last financial crisis. Central banks and institutional funds are accumulating gold at a pace that reflects growing concern over counterparty risk. Gold carries no promise, no obligation, and no default exposure. That is precisely its value. When confidence in contracts fades, capital migrates toward assets that require no trust. This shift is not speculative, it is defensive positioning by the most informed participants in the financial system.
But honest money, savings-based money, that's the antidote. And that's what puts you in the best possible position to sustain your reasonable standard of living today and take advantage of those opportunities that are headed our way tomorrow and not very far down this road. I know that there are opportunities because what the Zang Enterprise Sound Money strategy is based on is those repeatable patterns. How about for once in this massive wealth transfer scheme, how about for once that wealth transitions your way? You can do that just by holding your purchasing power intact. That's all. It's not rocket science. It's not complicated. You don't need to be some special kind of engineer to understand gold and silver, physical gold and silver. It's real. It runs no counterparty risk. It has the greatest demand. And we need to get this in the global monetary system again, because if we allow the digital system to take over, are you ready to be a complete slave? I'm not. That's not what I want to leave. That's not the legacy to leave for our children.
Modern financial products often blur the line between assets and promises. Digital instruments, futures contracts, and synthetic exposures all depend on system integrity. Physical gold and silver do not. They represent savings-based money, assets that cannot be printed, diluted, or erased by policy. Silver's broad industrial and monetary demand reinforces this role, making it resistant to centralized control. Price suppression in paper markets does not eliminate physical demand. It hides it. Understanding this distinction is essential because debt-based money always fails eventually. Honest money does not.
So join me in this sound money movement. Locally, create that community around you so that you can create that surety in food, water, energy, security, barterability, wealth preservation, community, and shelter. Get it done. We are fast running out of time, and not you nor I will know the exact second that debt bubble is going to explode. But you better be prepared when that happens, because there won't be any time to do it after that. The time to get prepared is now, and the time to join the global sound money movement and demand sound money back in our global monetary system again. That time is now. And I know that together we can do this because we've got the 99% that are ruled by the 1%. So if we get 3% of the global population to participate in this, we got everything we need to protect our savings, to protect our children, and to take our power back. What a concept.
Systemic resets offer opportunity, but only for those positioned in advance. Once a debt event unfolds, preparation becomes impossible. Wealth preservation, community resilience, and access to real assets matter more than speculation. History shows that major financial transitions reward those who maintain purchasing power rather than chase yield. Sound money is not ideology, it is survival strategy. As the global system moves toward greater control and digitization, maintaining independence becomes critical. The window to act is narrowing, and preparation today determines security tomorrow.